They told us the housing market was recovering, that the worst was over, that brighter days were coming. But behind every headline is a hand holding the pen. The ANZ quarterly report is out, so today we speak with the man behind the data, not the salesman, the signal. ANZ senior economist Miles Workman. Let's find out what he really sees coming before the next chapter is written. If you like making money rather than watching everyone else do it, hit that subscribe button because the numbers don't lie. More investors are getting the New Zealand housing and real estate intel from this show than any other YouTube channel in 2025. Miles, is this really a recovery or just a pause before another correction?
Well, I think all signs are pointing to a gradual recovery, but I would say it's what I'd characterize as a fragile recovery at the same time. So underlying economic momentum does appear to be bottoming out, perhaps even turning a corner, but it is happening gradually. And when I say fragile, I mean, essentially, we've got these global potential shockwaves that are rippling through financial markets currently with the Trump policies and what that might mean for growth in China, but also business confidence domestically. And you put all that together, and it's fair to say that things are at risk of sort of becoming a little interrupted along the way. But at the current juncture, I think we can still quite comfortably look at the timely forward indicators and conclude that there is a recovery underway. It's just not a gangbusters one at this stage.
Well, a slow and steady recovery is probably to our benefit. What are New Zealanders not understanding about how interest rates actually impact their house prices?
Well, I think one thing to be wary of is you do need to be a little bit careful what you wish for, in the sense that if the housing market does take off a little bit more rapidly, perhaps, than the Reserve Bank are hoping, we have to remember that the Reserve Bank still aren't completely confident that they've fully tamed CPI inflation pressures, and a premature acceleration in the housing market, whether that flows through to the cost of building a new house or even flows through to rents. Those two things together, they're about 20% of the CPI basket. So if the housing market starts taking off a little bit prematurely and perhaps stronger than the Reserve Bank are forecasting, they're likely to conclude that's an upside risk to the inflation outlook, and therefore it could mean an upside risk to the interest rate outlook. So I think the best thing we can really hope for at the current juncture is that things remain on an improving trajectory, but probably not too gangbusters, at least from an inflationary perspective.
And how are you seeing the net migration figures impacting that increase in house prices? Is it because net migration is down a bit that's slowing things down in our favor as well? Or?
Yeah, well, the thing to remember with the net migration data is it is very, very volatile. So essentially, when we get the data, you do have to wait about 3 months for it to settle down because it is subject to significant revisions. But tentatively in that data, there is a bit of a turning point occurring. So essentially what we're seeing is departures are at a very high level, but they are stabilizing. Meanwhile, the arrivals are starting to pick up. So what that suggests is the net migration cycle is in recovery mode alongside the broader economy. And that's reflective, I think, of what's going on with underlying economic momentum. But at the overall, the absolute story, it's certainly not a high migration story relative to where we have been in the past. So in terms of a housing impulse perspective, I'd say migration is still looking relatively neutral right now, but that is one driver of housing demand, which does look like it's beginning to recover alongside the broader economy.
And as we look at how government is spending the money, is this slowing the market down or is it saving us from ourselves?
Well, fiscal consolidation is happening very gradually. So if you think about the OBGAL measure of the operating balance, around 10 years of persistent deficit following the COVID pandemic, there's no way you can call that a cyclical helping the economy out when it needs help type of deficit. It's what economists would refer to as a structural deficit, a deficit that's persisting sort of regardless of what state the economy's in. And as I mentioned, the consolidation is happening very, very gradually, with those deficits forecast to persist for the Treasury's entire forecast horizon, which goes out to June 2029. So I think the overall fiscal story is very neutral, broadly, versus what it could be if the government was consolidating faster than otherwise. The big picture here, though, is under the hood, there is a little bit of a compositional change happening with fiscal settings. So what we are seeing is the government is making cuts to its spending versus what was already baked in. And then it's taking those savings by spending less and giving that away as tax relief. So we saw that with the investment boost policy in the budget. So what that means for the economy is, at the aggregate level, that's not really a game changer. Smaller government, bigger private sector. But those in the private sector, and businesses and households in particular, are likely to feel a little bit rosier than otherwise in that world, because the space in the aggregate economy for businesses to grow and household income to grow is a little bit larger than otherwise.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart and subscribe. And if smarter investors are looking forward maybe 12, 24 months, what should they be looking for in the inflation and wage growth side of things?
Yeah, I think the upshot here is the Reserve Bank has to be confident that they've done enough to tame CPI inflation. And the key indicators they're always going to look at there are basically how much capacity stretch is there in the economy. Is this economy running with a degree of excess capacity in which would lead to further disinflation progress? Or are capacity constraints beginning to come back? So if you look at the Reserve Bank's forecast, our forecast as well, we expect what we call a negative output gap to persist for the next few quarters, essentially meaning that if you look through some of the volatility in the CPI data, you would expect that to relate to further disinflation progress as time goes on. Now, we have a lot of indicators that tell us, give us a snapshot for how much capacity there might be in the economy at any one point in time, at any given point in time. So that's things like our Business Outlook survey, the NZIER's quarterly survey of business opinion, and of course the labour market, with the underutilisation rate and the unemployment rate, all being really good indicators to give us a feel for how much spare capacity the economy is currently operating with. At the moment, the good news is, from an inflation perspective at least, the good news is there is further disinflation progress in the pipeline. There does appear to be a degree of spare capacity. But the painful side of that same coin is that does mean that the unemployment rate is a little bit more elevated than perhaps would be consistent with full employment. And we actually are forecasting the unemployment rate to rise a little bit further from here, peaking at just under 5.5% this year. So I think when you put that all together, the signal essentially is there is a degree of spare capacity in the economy. That's a good news story for underlying disinflation progress, and therefore should hopefully give the Reserve Bank confidence that they've done enough to tame inflation pressures over the medium term. But at the same time, that loose labour market is not a good news story for households, and it does mean that households have less bargaining power than otherwise, which ultimately means lower wage growth than otherwise. But that's all part of the same mix, isn't it? If you think about it, it's that labour cost is the wage component, and to get that labour cost down and prevent labour costs from flying through into CPI inflation pressures, that's how the Reserve Bank is needing to manage the business cycle. We did have a Reserve Bank that came out right from the get-go, basically telling us they were going to engineer a recession and cause this economic pain in order to tame inflation. That's exactly what they've done. It appears to be working, but of course it does hurt some households more than others.
And if they look to reverse back on some of that now, OCR predictions being adjusted down to 2.5% now?
Yeah, so I would say that the market's somewhere in between 2.5 to 3%. The signal from the Reserve Bank at the latest MPS was a trough there of 2.85%. So they're kind of in the middle there with their signal. What we are starting to see in the data, though, is a little bit more robustness, perhaps, than we have been forecasting. So we've got GDP data that's out next week. There is some of the partial indicators that have come through do suggest that there might be a bit of upside risk to the Reserve Bank's growth forecast. Similar with the CPI impulse, there's a bit of evidence accumulating that perhaps the Q2 CPI data might be a little bit stronger than the Reserve Bank were forecasting in the May MPS. And ultimately, that may cause the Reserve Bank to tread just a little bit more cautiously as they deliver further OCR cuts. So I suppose what I'm trying to say here is the Reserve Bank has sent a signal that they are very much in data-dependent mode. The OCR is going to go where they think it needs to go based on how the data roll in. And in the very near term, at least, it looks like some of that data is coming in just a little bit more inflationary, perhaps, than their forecast. But we as central bank watchers and forecasters have to step back from that sometimes and make a call as to whether we think that's going to persist, i.e. are we in a world where there's slightly longer lags than previously thought between changes in monetary conditions and inflation outcomes, or has something changed post-COVID? Are we in a structurally higher inflation environment? And these are questions that I don't think any economist can actually answer. In the fullness of time, the data will reveal the truth. But we as forecasters and even in the Reserve Bank building, they are constantly having to make judgments and reassessments of how inflationary they think the economic conditions are and will be going forward. And there's a lot of uncertainty there. So I suppose, I think when you boil it all down, what does it mean? Well, I think the Reserve Bank strategy has been get the OCR to broadly neutral territory, which they estimate to be anywhere between 2.5% and 3.5%. So you could kind of argue that they're in that zone now at 3.25. If they cut once more, 3%, they're in the middle of that neutral zone. And then it's very much a feel your way as you go. Perhaps a couple of pauses in there you couldn't rule out. It's really going to be data dependent. So officially, our forecast is a 2.5% trough, and that's persistent 25 or consecutive 25 basis point cuts to 2.5%. But, it'll only take one decent data surprise for us to rethink that and maybe either rethink the terminal where the OCR troughs or rethink the speed at which the Reserve Bank takes it there.
Well, I appreciate your insights today, Miles, and recommend anybody that likes data and the deep insights to have a look at the ANZ reports. Look forward to catching up again soon, Miles.
Thank you very much. Yeah, thanks, Andrew.
A final reminder, money moves fast and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.